What is venture capital and who are venture capitalists? Well, venture capital simply refers to the investment in money into business ventures. Venture capital happens at every stage of the business venture, small businesses and large businesses. But the term venture capital is often used to characterize a specific firm that goes about raising money from outside investors, third-party investors. They collect that money and they invest that money into startup ventures, okay, growth-based ventures, and they hold that interest on behalf of these investors. And when ultimately they later sell that ownership interest, when the fund closes, as they say, then they harvest the value from selling off the interest that they have purchased earlier in the life of the business venture. And any profits from that, they share with the investors in the fund. So venture capitalists are professional financial investors, raising money, investing that money, taking a portion of that money, and receiving a share of any profits from return of money when they sell the ownership interest that they've purchased via investment. Now, they only invest in scalable ventures. That means ventures that can reach a large audience, generally with a highly repeatable business model. So they're not looking for your small businesses, your mom and pop shops, your slow growth type businesses. They're looking for businesses that have the potential to grow very, very quickly, that they can use the money that's invested, the capital, to achieve exponential growth. And this is how it offers the potential return that the venture capitalists are looking for. That is, the high risk of failure is matched with the high potential of extreme financial success, often 20, 30, 40, 50 times the investment over a 3 to 7 year period. So here's generally the way venture capital is structured. You have a venture capital firm, and these are the financial professionals that manage money. Then you have outside investors who are generally high net worth individuals, money funds, other private equity funds, endowments, things of that nature that seek to allocate a portion of their assets to higher risk ventures with the potential for higher return. So the venture capital group organizes this. These investors take on the form of limited partners in a partnership. The venture capital firm are the general partners, and they form a limited partnership whereby the investors put in capital. The venture capital firm invests that money into various companies, investment companies, and they hold the ownership interest in the venture capital fund, the general partnership. And ultimately, usually the investments happen periodically. They don't all happen at the very beginning. It happens throughout the life of the fund. Most funds last for about 10 years. So investments will be made throughout, and ownership interest in firms will be sold out of the fund at various points. They call that harvesting the investment. And ultimately, when the fund closes, the investors hopefully will receive a return on their investment. The venture capital fund itself generally makes money by receiving management fees and sharing any profits from the sale of the ownership interest that they've purchased earlier on. Now, the venture fund generally will invest in funds usually at A series round, B series, C series, D series in there. They usually don't make seed investments, the early stage investment. That's more for friends and family and angel investors. The venture capital groups are in that middle tier. And then later on, when you get into mezzanine financing or financing before going public or final acquisition, you'll get into a larger private equity group or strategic acquirers that are purchasing an interest in the fund. Now, down to how venture capital makes money, even if the investments lose money over the life of the fund, the venture capital fund still makes money because they receive management fees for managing the investments. Okay, and that's a certain percentage as established between the investors and the VC fund for managing the money based on the amount of money held and the amount of money invested. And the investors put money in throughout the life of the venture. It's not all put in at the very beginning. It's called down from the fund when needed from the investors, and thus allocated when needed throughout the life of the fund. And so they also receive a revenue share from whatever they generate from selling off these investments at the end. Generally, the investors have a catch-up period, or the right to receive back their investment in the fund before the sharing of profits from the sale of the ownership interest in businesses is split between the venture capital group and the investors. But this is generally how it's structured, how it works. This is why venture capital firms, when they're successful in investing in entrepreneurial ventures, why they tend to generate so much money is because, once again, they are receiving a management fee, they are investing other people's money, and when they make money with other people's money, they take a percentage of that as well. So that's the overall structure. That's how it works. That's the objectives of venture capital.